please go ahead and educate us.
Okay, happy to. Do I have a presentation or what do I have?
There you are.
Yeah. All right, cool. All right, great meeting everybody. And, I'm here to give you a practical window into what this blockchain technology can do for the real estate space, specifically addressing real estate investing, because there's lots of things actually within real estate that blockchain can do. And yeah, please move the slides. Okay, awesome. So this early project that we were privileged to be involved with was the St. Regis Aspen Ski Resort tokenization, Aspen Coin, which was probably the first commercial real estate project in the world. And it at the time, it was raising $18 million. And initially, they were looking at an IPO structure. Part of the reason was because some of the early investors wanted to exit early. One of the biggest problems in real estate is lack of liquidity. When an investor comes into a project, they will expect generally to stay with that project for 5 to 7 years. Sometimes there's some ways for investors to exit by speaking to the sponsor, but in general, they're expected to stay, right? So in this specific project, an IPO early on was considered. Because of the costs of the IPO, those plans were scrapped, and the owners, Elevated Return, the issuer of the Aspen Coin, they actually knew about the STO, then this new trend coming onto the market. They were looking for a tech provider at the time, and they found SolidBlock. And that was in basically mid 2018. As I mentioned, the capital required was 18 million, which was about 19% of the equity in the project. There was also a mortgage on the property with JP Morgan, and they were comfortable with up to 20% of the equity tokenized. So hence this weird number, 1914. In Q4 2018, the smart contract and all of the underlying regulatory requirements and compliance were completed, and as well as the fundraise, and which actually, do I have more slides? I don't know if I should keep talking. Actually, yeah, okay, great. So this property was, as iconic as it gets. A lot of people know it. Most people who ski know this property. As I mentioned, there was a mortgage on the property, and the appraisal value at the time was 224 million. And so how did the team, which was actually a really big team of professionals, execute this project? So the project included a lot of lawyers. Okay, a lot of lawyers, because every tokenization starts with the legal component, right? So at the end of the day, this is a traditional security offering with a digital component, right? So traditional security offering requires a private placement memorandum, requires a form D submitted to the SEC website, and also, so basically what was done here was the Reg D 506C offering. So there were a few law firms involved. They did their part, then SolidBlock did our part. We created the smart contract, which was on an Ethereum standard, ERC20 standard. And that smart contract essentially, as Jake explained, shows the ownership of that security, right? When investors came into the offering, they came through a landing page, which basically had all the outline and unique bits of the offering. They could download the PPM, they could view all the data. At that point, they had to undergo KYC and AML, know your customer, and anti-money laundering. And basically they had to fill in a questionnaire, and as well as accreditation. So they had to show that they are accredited investors in accordance with the Reg D 506C requirements. And then they were able to transfer the funds to whatever bank account specified. And that was the initial process on the day of their investment. When the investment was completed, when the full 18 million was gathered, then the investors actually got the tokens essentially into their wallets, right? It's important to mention that the wallets generally, so as Jake explained, they could be held by individuals. So these are kind of more decentralized type of wallets. They provided by one of the blockchains, but also you could have wallets that are provided by some of the institutions or companies that are more user friendly. So you can actually have they're in charge of your password. If you lose it, you can actually recover it. So those types of solutions are more frequently used by the industry just to make a user experience better for the users, right? So this is the type of the solution that we use, and that's where the tokens were distributed. Can you move to the next slide? Okay, fantastic. So and then I should have mentioned that at the end, Reg D 506C has a lockup period of 1 year. So whether or not the offering is digital, the investors usually can't trade their tokens for about 1 year. Well, there's some exceptions applied in various cases. You can shorten that to about 6 months. But in general, for this offering, it took 18 months to list it on an exchange, and now it's trading successfully. It started trading actually at a 28% premium, meaning that it was issued at $1 per share. So $18 million is essentially 18 million shares, 18 million digital securities. And when it was listed on an exchange, it was listed at $1.28. So let's review quickly what are the differences between a traditional and tokenized offering, because Reg D 506Cs are done, they have been done for some time, essentially from year 2012, when the Jobs Act was passed. That was the act passed by the government to help SMEs, essentially smaller real estate companies, to raise money, so to raise funding, so that the investors are more incentivized, right? That they can put money in and they can take it out before 5 or 7 years, which is generally the cycle of a real estate product, right? So in a traditional offering, if the issue was to do it in a traditional offering, they would just issue some sort of a PDF file, or maybe put the investor in sort of a database online, and that's where their name would be written after they put the funding in, right? So that does not allow anybody to trade their securities easily, as well as it raises a lot of questions. Do I really own this security? How can I prove that I really bought it? It was really me, right? So there are higher admin costs in general in a non-blockchain environment. There's definitely a high liquidity risk because you cannot sell easily this security, right? So especially, what happened with Aspen Coin was really interesting. If you look at the historical data on the pricing, and 2019 was a really good year for them. Late 2018 and 2019 was a really good year. And it led to dividends being paid out that was actually higher than projected. So the 4.7 actually became 6.2%, and the Aspen Coin went, it went up in value, right? It was around 30% premium, then even higher, went to 34, and then COVID hit, right? So that their annual report or their quarterly reports were not as good, right? So the Aspen Coin dropped to $1, right? Earlier Earlier this year, it went back to $1, maybe even 99 cents, at which point a lot of people started buying it. So, also again, as Jake mentioned, a lot of these products, behave similar to stocks. There is a big difference between Bitcoin and Ethereum and other crypto that is really based on kind of the trust of the individuals into the system. Real estate and security tokens are different. They are usually the value of the token is tied pretty heavily to the underlying asset. So we're not going to see a huge disconnect of the price from the actual value of the asset, which is continuously being appraised, right? So as you saw during the pandemic, a lot of people, the price of the stock went down, and kind of the market did its thing, right? Which would not be an option had this not been tokenized, right? So, and of course, there's a higher liquidity cost, right? So if you do want to sell, you have the option to go to either a broker or to the company, the sponsor, and so on, and exit, but then you're going to have to pay penalties. There is a question here about whether all the 18 million shares were purchased by one entity. And the answer is that they were purchased by 22 entities in the investment sizes that ranged from $10,000 to over $2 million, right? Which the higher ticket was bought by a fund. And these investors were mainly from the US, and then there were some from Hong Kong and other places in Asia, through what's called a Regulation S, which lets you market your security to individuals outside of the US. And so these 22, actually, once it was issued, were quickly rose to 200. Sorry, once it was listed on an exchange, quickly rose to 200, and now there's over 1,000. And yes, tokenization essentially is syndication with a digital component, meaning we write the ownership on the blockchain so that we can trade, right? So in reality, the tokens replace paper certificates. You have this ledger. If you were using a public blockchain, right, there's public and then there's permission blockchains. In the public blockchain, you actually are able to see all of the transactions online, right? So we have on Ethereum, we have a website called Etherscan, right? And there you can see all of the transactions that this security has undergone, which is fantastic for transparency. You can see how popular security will be, right? So on the so accredited, as far as accredited investor versus non-accredited, in this specific example, Reg D 506C was used, which is the majority of the securities that are issued today. And that's for accredited investors at this stage of issuance, right? Then on the secondary market, depending on the licenses that the exchange will have, retail investors may have access to the security. There are other types of regulations, Reg A+, for example. Now, in a few new, a lot of platforms are using Reg A+, which is a regulation that is a little bit more complicated. It takes time to, actually in this case, you have to get an approval by the SEC as opposed to Reg D 506C, where you just notify the SEC. And the Reg A+, you can actually raise up to $75 million from retail investors. You can also use Reg CF, crowdfunding regulation, where you can raise up to $5 million from retail investors, again, without any specific approvals from the SEC through a licensed platform. So secondary trading. So Aspen Coin was listed in August 2020 on T0. T0, actually the smart contract was rewritten for the Tezos blockchain. So they're now using that blockchain instead of Ethereum blockchain standard. And so T0 is an automated trading system with a license to trade security tokens or digital securities. And as I mentioned initially, it rose as much as 30%. So we actually believe that just by virtue of an asset becoming liquid, it's going to be valued higher because there will be a higher demand and higher access to that security. In terms of secondary trading, obviously it provides investors a lot of benefits, most of which I already mentioned. Is that it, or do I have anything else, guys?
No, I